I guess when you write too much, they don't like you to be on it. So I warned people in July of 21 that 22 was going to be a disaster, potentially the worst bear market we've ever seen in our lives. I don't know why that would change. What I hear from watching, occasionally I do watch CNBS and Bloomberg et al. I want to hear what the major, market gurus are saying. I don't sense any panic yet. As a matter of fact, if you, go to a party and you talk to individuals, they're all saying, well, when is the Fed going to step in? And if you listen to the Jim Cramers of the world, the bear market bottom happened, maybe a month ago, he said the bear market bottom was in. And we got to look for a chance to buy the dips here. Because don't you know the Fed's going to come and save the day? Well, I just don't see that, Again, I could see that. Let's just say inflation was 4%, not 8.6%, 4%. So close to the Fed's 2% target. Then you can come up with a scenario where the Fed is like, well, we're close to our 2% target range and we don't have to be aggressive anymore. Let's say the Fed's balance sheet was 4.5 trillion, where it was prior to the pandemic, not 8.92 trillion like it is today. You can't talk about the Fed turning dovish when the Fed's balance sheet is up 4.5 trillion over the last 2 years. You can't talk about the Fed turning dovish when inflation is 8.6, not anywhere close to 2. You can't talk about the Fed turning dovish if the Fed funds rate, now this is the real Fed funds rate. So you take the Fed funds rate, which is 0.75% to 1% minus inflation. If you deflate that Fed funds rate by the 10-year break-even rate, we're at minus 1.99%. If you look at the real Fed funds rate and deflate the nominal or effective Fed funds rate by CPI, we're minus 7.88% on a real Fed funds rate. Why is that important? The Fed has to get to neutral at least. So let's just say the Fed says, I don't want to be stimulative, nor do I want to be restrictive. I want to get to a neutral monetary policy. They want the Fed funds rate to have a real rate of 0. They're light years from that. Light years from that. And so is inflation above their target, and so is the Fed balance sheet, way above where they want to be. So I never got this nonsense that I heard, I was like alone on an island pretty much. Well, the Fed's got your back. Well, the market's down. Don't you know the Fed's going to come to the rescue? Don't you know inflation peaked? Who the heck cares if inflation peaked at 8.5% or 8.3%? And it goes down to 7.9, which I think it will in the next few months. Who cares? The Fed has so much work to do, and they have to do it because they're so stimulative and they've lost control over inflation. So the market is still very expensive. If you look at almost every metric on the planet, it's overvalued and has a lot of work to do yet on the downside. Until you see inflation retreat closer to 2%, and you see that happen without the economy crashing. Okay, because it makes no difference to me if the economy is crashing, but inflation goes back to 2%. So you have to have the inflation come down swiftly, yet also have a relatively robust economy. You do not have either of those cases right now.
So a lot of our viewers have been watching and with great concern for some period of time, over a year, most of them for multiple years, waiting for some major convulsion because there's been this disconnect, as you described, between reality and mathematics versus the attitude that's prevailed, the prevailing narrative on the mainstream financial press, just saying like, as has happened for the past 40 years, we're going to be back to the races again, and there's the Fed's got your back, and away we're going to go again. And you and others have been pointing out that there have been structural changes and just mathematical corners painted into over the past several years that say, no, we can't just persist and expect more of the same. some of our viewers, many of them, are looking for major signs that we've reached a crisis point, a turning point, where there will be this awakening on the part of many that will actually shift the game out of this sort of delirium that we've been in. Do you see any specific indicators? You watch a lot of forward-looking indicators in your model that tell you that the game is fundamentally changing at this time.
The game is fundamentally changing to the downside? I mean, is that what you're talking about? Talking about the credit market? So if you're asking me the direction of stocks, the direction of stocks is much lower in my opinion. I monitor the credit markets assiduously, and I see fractures in the credit markets, not to the point where we've reached a massive liquidity crisis yet. So that's still in front of us. I have that penciled in for the fall of this year.
Penciled in on your appointment calendar.
Yeah, because listen, the Fed's going to raise interest rates 50 basis points in June, 50 basis points in July, 50 basis points in September. And then in September, quantitative tightening goes from 50 billion to 95 billion per month. The amount of tightening that we see right now is commensurate with the pace of hikes that we saw under Paul Volcker. So if you look at where the Fed funds rate was in actuality, it was deeply negative. It went to zero in nominal terms, but if you look at quantitative easing, that rate was -2 or greater percent. So that ended, that took the interest rate back to zero. Now we're at 3/4. Now we're starting QT. The amount of tightening is just astronomical on top of an economy that's so over-leveraged on every front. It was over-leveraged to buying Bitcoin, over-leveraged to buying tech stocks, way over their skis in the real estate market. We haven't even saw that shoe begin to drop. You have a dramatic reverse wealth effect now going on. The average, this is not me, the Vanda Research came up with the data. The average portfolio, 60-40 portfolio, stocks and bonds, is down 32% this year. Now that's shocking given what we're used to. And that's why I keep hearing everywhere I go, when is the bottom in? When do we bottom here? When do we buy? That's been inculcated to us since 1987. Well, I would ask, maybe we're in Japan 1989. Would you ask the premier of Japan in 1989, when do we buy? Or even China in 2007, when do we buy? The answer is it could be decades away. It could be decades away because of this massive artificial construct called the U.S. economy. And that's true all over the developed world. There's nothing, look at what's going on in Japan, for example. Japan's currency is crumbling. Mr. Kuroda, who's in charge of their central bank, he has a conundrum. He can either cap JGBs, Japanese government bonds, 10 years in duration, at 0.25%. This is an insolvent nation, Dunnigan, with a quadrillion yen in debt. He's tapping the yield on the 10-year note at 0.25% by printing unlimited. He said it. I will print. This is Haruko Kuroda, the head of the Japanese central bank.